Welcome to Online Money with Peter. Trust you are doing great. My name is Peter. So you're thinking about getting started with investing. Maybe you've managed to save up a bit of money, not quite enough for a house, but enough to start thinking about putting it to work. You could invest in stocks, bonds, real estate, foreign exchange, crypto, NFTs, futures, fine art, watches, and so much more. There are endless options, and you've probably come across ads from gurus on YouTube touting day trading, foreign exchange, and how you can make quick profits through investing. But with all this information comes the very real fear of losing the money you've worked so hard to save. This is the ultimate guide to investing for beginners, and we're breaking it down into 4 parts. Each section will be time-stamped so you can skip ahead if needed. Part 1 covers the basics and the core philosophy behind investing. Part 2 explains how and why you should invest in stocks and shares. Part 3 tackles common fears, questions, and concerns like, what if I lose all my money? Part 4 explores fast-lane investing, an alternative to traditional methods for building wealth. Let's dive into Part 1, the philosophy and basics of investing. To start, what's the point of investing? The goal is for your money to make more money. Suppose you've saved $1,000 from your hard work. You could stash it under your mattress or leave it in a bank account. But here's the problem. There's this thing called inflation. Right now, your $1,000 might buy a MacBook Air. But in a few years, as inflation rises, that same laptop might cost $1,200. So over time, your money loses purchasing power if it's just sitting idle. This is where investing comes in. It helps your money grow and counteracts the effects of inflation. But how does your money grow when you invest? The basic idea behind investing is that you buy something now, and over time, it increases in value. Let's take buying a house as an example. When you buy a house, there are 2 ways it can make you money. 1, rental income. You can rent it out, earning a monthly income. 2, appreciation. Ideally, over time, the value of the house will increase, meaning you can sell it for more than you bought it. If you hadn't invested in the house and just kept that money in a bank, inflation would gradually erode its value. Real estate is a clear example because most people are familiar with rental income. However, with other asset classes like stocks, bonds, or even art, there's no direct rental income. Instead, you're buying in the hope that you can sell these assets for a higher price in the future. Some investments, like certain stocks and shares, can provide income through dividends, which we'll cover later. And while the list of investment options, stocks, bonds, hedge funds, index funds, can seem overwhelming, the principle remains the same. Your money works for you by growing over time. You might have heard of people investing in watches or fine art, or perhaps you've come across stories of massive gains or losses in cryptocurrency. In fact, many of us, myself included, may have lost quite a bit when crypto markets crashed recently. The world of investing can get complicated pretty fast, and that's why we're going to simplify things. For the rest of this guide, we'll focus on investing in stocks and shares, because this is the most accessible way for everyday people like you and me to start investing. Unlike real estate, you don't need a huge amount of money to get started. You also don't have to take on the massive risks associated with crypto, and you don't need to be an accredited investor to participate in the stock market. Stocks and shares are the basics of investing. And when most people talk about investing, they often mean buying stocks in well-known companies like Tesla, Netflix, or Amazon. Now let's move on to Part 2, why and how to invest in stocks and shares. When you invest in stocks, you're essentially buying a small piece of ownership in a company. For example, if you wanted to buy shares in Apple, you'd be buying a small percentage of the company. Apple is a publicly traded company, which means the public can buy and sell its stock. Ideally, it would be as simple as going to apple.com and clicking buy. But in reality, you need to go through a middleman known as a broker. Once you've used a broker's platform, you officially own a part of Apple, or whichever company you invest in. There are 2 main ways to make money from stocks. 1, capital appreciation. This is when the value of the stock increases over time. For example, you might buy Apple stock today with the hope that 10 years from now, the price will have significantly risen and you can sell it for a profit. 2, dividends. Some companies pay out dividends, which are a portion of their profits distributed to shareholders. For instance, a company like BT, British Telecom, in the UK pays dividends to its shareholders. So if you own shares in BT, you're not just hoping the stock price will go up. You'll also receive periodic payments from the company's profits. While most of us won't own large percentages of companies like BT, you might earn small amounts from dividends, $5 here, $10 there, across different companies. Over time, this can add up and feel like a kind of passive income. So at this point, you might be wondering, how do I choose which companies to invest in? Should you put your money in Apple, Netflix, Disney, Shell, or Unilever? Here's where people have different approaches. But I'm going to share an opinion that aligns with investing legend Warren Buffett. If you're new to investing, you shouldn't try to pick individual stocks. Unless you're a financial professional who does this for a living, you likely won't have the knowledge or insight to pick the right stocks or know the best time to buy them. Instead, you can invest in a whole basket of stocks through something called an index fund. With an index fund, you don't need to predict which specific companies will succeed. You're essentially investing in the overall performance of the market. For example, you can buy into a fund that tracks the entire US stock market, meaning you own a tiny piece of every major company in America. This way, your investment is diversified, and you don't have to worry about choosing the next Apple or predicting Disney's performance. Index funds and why they matter. Financial professionals spend their entire careers analyzing stocks, bonds, and other investments. Even they often struggle to accurately predict market trends consistently. This is why, for the average investor, stock picking is not usually the best approach. Instead, a more reliable and stress-free strategy is to invest in index funds. 1. What is an index fund? An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to mimic the performance of a specific market index. A market index, such as the S&P 500, represents a segment of the stock market. In the case of the S&P 500, this index includes the 500 largest publicly traded companies in the US. By investing in an index fund, you are essentially buying a basket of stocks that mirror the composition and performance of that index. For example, the S&P 500 includes large companies like Apple, 6.4% of the index, Microsoft, Amazon, Alphabet, Google, Berkshire Hathaway. Towards the bottom of the list are smaller companies like Hasbro and Ralph Lauren, which hold much smaller portions of the index, e.g. 0.21%. 2. Why choose an index fund? The key advantage of an index fund is that it allows you to invest in a wide range of companies with just one purchase, reducing risk through diversification. By spreading your investment across 500 different companies, your portfolio is less affected by the performance of any single stock. For instance, if one company in the index performs poorly, the losses are balanced out by the successes of others. If you invest $1,000 into the S&P 500, your money will be allocated proportionally to the weightings in the index. 6.4% of your investment, or $64, will go into Apple stock. 5.4% of it, or $54, will be invested in Microsoft. Only a small portion, such as 0.015%, will be allocated to stocks like Ralph Lauren. This method of diversification offers a much safer way to grow your wealth compared to picking individual stocks. The Warren Buffett endorsement. Warren Buffett, one of the most successful investors of all time, strongly advocates for investing in index funds. He suggests that for most people, the best approach is to simply invest in an index fund like the S&P 500 rather than attempting to pick individual stocks. His reasoning is simple. The stock market, and especially the US market, tends to grow over time. By investing in a large basket of companies, your money will grow with the overall market performance. Buffett famously said, if you had an extra $100,000 to invest, you should just put it straight into the S&P 500. This way, you are not attempting to outsmart the market or predict which individual stocks will perform best. Instead, you're betting on the long-term success of the largest companies in the US. 4. The alternative, stock picking. Some people may still prefer to try picking individual stocks themselves. In this case, the idea is to buy shares in companies that you believe will outperform the market. However, this approach is generally much riskier. Studies and experiments, including one led by Warren Buffett, have shown that very few investors consistently beat the market over time. Picking individual stocks requires deep knowledge, constant research, and in many cases, a fair amount of luck. While it's possible to experience short-term gains, the long-term reliability of an index fund often makes it a smarter option for most investors. Investing in index funds versus the fast lane to building wealth. Index funds, the slow lane to wealth. Investing in index funds, like the S&P 500, is often referred to as the slow lane to building wealth. This method is straightforward, and while it might not deliver fast returns, it's reliable over the long term. Index funds perform in line with the overall market, making it difficult for actively managed funds or individual stock picks to consistently outperform them year after year. Many studies, including those championed by Warren Buffett, show that most actively managed funds fail to beat the market over the long term. The beauty of index funds lies in their diversification. When you invest in an S&P 500 index fund, your money is spread across 500 of the largest companies in the US, from giants like Apple and Microsoft to smaller companies like Hasbro and Ralph Lauren. If one company underperforms, the losses are typically balanced by gains in other stocks. Common concerns about index fund investing. A common concern for new investors is the fear of losing money. While it's true that stock markets fluctuate, history shows that markets tend to recover over time. For example, during the 2008 financial crisis, the market fell drastically, but by 2012, it had fully recovered and continued to grow. If you had invested before the crash and held your investments, you would have likely seen significant gains over the following years. The key to success in index fund investing is patience. Over the long term, the market has historically trended upward, and index funds take advantage of that. As Warren Buffett famously advises, investing in the S&P 500 is a safe, long-term bet because the largest companies in the US are unlikely to all fail at once. How to get started with index funds. Getting started with index funds is easier than ever. You can't just go to S&P500.com and buy shares, but instead, you'll need to use an investment platform. Depending on your country, you can find various online platforms that allow you to invest in index funds. In the UK, for example, popular platforms include Vanguard and Trading 212, both of which have low minimum investment requirements, as low as £100 or even £5. Vanguard, one of the biggest names in the investment world, offers a range of index funds and is known for its low fees and simplicity. Platforms like these give you access to global markets and allow you to start with just a small amount of money. Thank you for listening to this time. If you have not subscribed yet to Online Money with Peter, please do to get notified with the concluding part of this ultimate guide to investing. Also join our membership program for more. I will see you next time. Bye-bye.